Recently, I have noticed a giant trend between intermediate and beginner investors that start off with dividend investing, and that's backtracking from your original investing strategy and thesis and leaning more towards growth. So today, I'm going to be talking about common trends that I've been seeing amongst newer investors. I'm also going to be talking about why dividend investing might be an overused slang, and talk about some mistakes that I think long-term could be an issue for every investor watching the video. Speaking of every investor watching the video, I want to know what type of investor you are. Whether it be dividend yield investing or dividend growth, I'd love to hear. Also, if you want to help support the channel, get access to exclusive episodes, stock market competition, and so many more perks, become a channel member today for only $5. It really goes a long way. You can get a behind the scenes look of what we're doing here, and it's a really great way to help. With all that out of the way, roll the intro.
Hello, I like money.
Alright, so on the Discord, link in the description, obviously, we often have these conversations about dividend investing, growth investing, and so much more. And one of our valued members, Auntie Buffett, had one of the craziest analogies that I've ever heard, and I had to share it on here. And he called it the cycle of an investor. Start off, it's dividend yield investing, then imitation of a successful or influential investor, and 3, you develop your own investing style. And that's the cycle of an investor. And I really had to share that. I thought that was so, well put. So to start off, we're going to kind of talk about this, the cycle of an investor when it comes to like a dividend growth investor or what a compound investor, I guess, is considered today. And they usually start off with dividend yield investing or that dividend investing. They typically get hooked on those 7% yield stocks like AT&T. They get addicted. They do the mental math, 7% yield, $7 per $100 I invest, and they start thinking about retirement and acting like Mr. Moneybags walking around town. That's how I was personally when I started getting my AT&T dividends when I began in dividend investing. You'll typically start off with dividend yield investing, and you'll typically get really addicted and hooked on that, or at least that's how I was, and you want to do more research on stocks. You eventually realize that dividend yield investing usually underperforms in the long term, although there are some good valid reasons to do dividend yield investing, which I'll talk about right now. Obviously, if you're living off of the income, I think it's acceptable to do a somewhat dividend yield investing, but you obviously want to make sure you're buying a quality business, more mature company. If you're buying these high yield stocks because they're being priced at a high yield, for example, a company like Altria, which actually is produces, solid free cash flow, or this just being naturally discounted by the market because of the industry that they're in, I will buy any amazing business no matter what the dividend yield is. And I think dividend yield ideally should be viewed as something that kind of values or tells you how a stock has performed recently. If you see a company that usually trades in the 1 to 2% dividend yield, trading in the 3 to 4% range, for example, Target, and you look at the company's payout ratio and you see that it's not something crazy, but I don't think you should be buying a business straight because of the dividend or dividend yield, which is kind of getting me in my next point. Here's why I don't particularly quote-unquote dividend invest anymore. I've been investing for 3.5 years now, and during my first and probably second year of investing, the dividend income would be such a huge thing for me. I can't even lie. It was really nice seeing my total dividend income go up by every time I would buy a new stock. Don't get me wrong, I did buy a lot of solid companies during my first and second year of investing, but I also did buy a lot of garbage and just a lot of mature businesses. They weren't even horrible companies in the first place, but they would be nowhere near the qualifications of companies that I look at today to add to my portfolio. A few examples of this were Kimberly-Clark, Colgate, Corning, Walgreens, and a bunch of companies that have led to me kind of underperforming over the last few years. I've sold out of a lot of those positions, but just mainly being the more mature businesses. I saw other investors buy them that are nowhere near my circumstances, investors that were relying on this income and using that passive income from the dividends to actually live off of it. So that was a huge thing that I think I did a mistake on, which gets me into my second point, which is imitation of successful or influential investors. This is something that I'm willing 99% of you watching this video have done once before. I'm guilty of it myself, and I even am kind of guilty today. My approach to this today is not to copy these influential investors. I'm going to give a few examples here. Let's say Joseph Carlson to start off. I see a lot of people copying his portfolio. I think one way to view it is getting inspiration and finding these stocks and allowing them to, those buys that they're doing, allowing you to get further research and get exposure to those companies. I think that's the way it needs to be viewed. Now, I'm not saying that Joseph Carlson is bad. I actually think his investing style is pretty good, and it's solid, and he promotes a good style of investing, but you cannot straight out copy it. Unfortunately, I'm not big enough yet because you haven't subscribed and smashed the like button for me for people to actually be imitating my investing style yet, but hopefully one day we'll get there. But I've seen a lot of portfolios where people are just straight out copying other influential people. I'm guilty of it myself. I'll be transparent here. I'll give some examples. Start off, Jeremy Lefebvre, tattooed chef. I had no due diligence. I was in a very vulnerable spot. I listened to his advice blindly and I bought a few shares. I was just nowhere near a huge loss, but there are some other examples that I'll share. I was a huge dividend data guy, which is the sponsor of today's video. When I began investing, and a lot of his buys I imitated as well myself without doing any of my own research after watching like one of his videos. Don't get me wrong, my imitation actually has worked for me a little bit. I got exposure to some really solid companies that I still hold on today: Visa, Microsoft, Apple, etc. But I also am responsible because of some losers because I blindly followed advice of him and others. For example, Intel, Walgreens, 3M. 3M was more on me, and that was kind of unpredictable, but just don't blindly follow people's advice off of one YouTube video. That's a huge mistake that I made, and a lot of investors have been doing this, and it's something that I think is kind of crucial to everybody's process. And lastly, you develop your own investing style. I think this is kind of where I'm at right now. I buy companies that I envision will do very well over 30 to 40 years, and that I can eventually use to live off of those dividends that they're going to be paying me, and have crazy yield on cost and use time to my advantage. That's where my investing style's at right now, guys. And I don't buy companies for the dividend or dividend yield. As we all know by now, dividends are the outcome of a company's free cash flow, business performance, growth, etc. Another big thing that I see investors doing is over-diversification and getting into the over-diversification trap. This is basically when you're really on a sugar high or enthusiastic about dividend stocks and you want to get diversification and exposure to every industry there is. Guys, you do not need that. The best way to approach that is just buying an index fund, to be honest. Now I want to talk about something that I think is kind of been important for me and something that I've been seeing a lot recently, which is letting others influence your investing thesis without doing proper research and looking into the facts. For example, this is clearly me with Target right now. Target is a business that I've done my own research on, and I'm getting shit from everybody on it. Do I think Target is the best business in the world? No. But do I think it's at a really good price right now, and I think it's a solid business that I'll do really good with at these prices over the long term? Yes. I'm not going to let anybody's own opinion keyword there, change that. A lot of people don't like Target because it isn't Costco, it isn't the new hot stock on the block, and it's down, of course. Everybody's telling me that I'm going to lose money on it, that it's a mid company, and so many more negative things around it. If I listened to them and sold out of that and some of the other companies that I'm losing out on right now in the short to medium term, I would be a bad investor in my opinion. While I do have some bad stocks in my portfolio right now, I don't think I'm just to sell because of others' opinions, and I think that should be the same way with you guys. If your original investment thesis remains the same on a company when you still bought it, and other people are telling you to sell it and the stock is even down, do not listen to them, listen to yourself. Realize that you have your own investing style and thesis, and you need to stay true to that and not let anybody's opinion, keyword opinion there, impact it. And lastly, I want to provide a quick insight on my current situation, my investing strategy, how it's changed a little bit. So to start off, I just want to invest into amazing businesses. Invest into companies that I see doing really well over the next 40, 50 years, companies that I can envision being in our society and thriving over that time as well. That's really been the driver of my investing style for a long time. Obviously, I'm looking for dividend/free cash flow growth because dividends are the outcome of a company's free cash flow, performance, etc. And obviously, for that dividend growth, my yield on cost to continue growing and the dividend snowball to go into effect, I'm looking for free cash flow machines at the moment. Companies that over time, their free cash flow grows and their business grows overall, and I'll be rewarded that way as a shareholder through dividend growth and buybacks. I want to see companies that are converting their revenue into free cash flow pretty consistently over the long term as well. Next, I also want to have some bets in my portfolio. As I am young, I'm not putting my entire portfolio in a SoFi, obviously, but owning and buying companies that I believe are at a discount that do have a bit of added risk to them. For example, Target, I think that's going to be big for me as well recently, but I do want to also have some locks in my portfolio. A lot of locks, actually. For example, Visa, Microsoft, Apple, just companies that are going to do amazing over the next 50 years, but I also do want to have some bets as well. And lastly, of course, just compound, baby. In all seriousness, though, I'm always growing as an investor. I always am open ears to hear others' opinions and facts that may be presented to me. And if you want to present any facts or opinions to me, do it in the Discord, link in the description. This video isn't to say that dividend investing is bad whatsoever. Do the investing style that keeps you invested and interact active with other people in the investing community and always learning. I think that's the best way of investing. I still own many quote-unquote dividend yield stocks today, and not to let anybody else's opinions inflect your investing style. I think that's the main takeaway from the video today, guys. If you made it to this part of the video, I really do appreciate you. If you haven't already, join the Discord, link in the description, become a channel member for exclusive perks, episodes, and so much more stuff on the way soon there. If you're here, that tells me that you want to make a difference in your life by investing, and there's no wrong way of growing your money. Thank you, and of course, do dividend stocks, not drugs. Have a good one.